The third question, again, these tie in and kind of build, and so I thought they were very good for us to have some of these conversations because it's kind of leading us to where we want to go with this. The third question is, how do we know when we're buying a good stock? Which is, again, is a great question. One of the things I want to do is distinguish between picking a good stock and building for your retirement. Those are generally two different things. Now, there are people who, for a living, pick good stocks to put in a portfolio from you to choose from. But when you're talking about investing in a good stock, you're talking about investing in a good company. So you have to think of a stock as a company. So to know what if the stock's good, you have to know if the company's good. And that's really quantitative analysis. That's a very technical, what we call technical analysis that's done on the company. It's not completely impossible for an individual to do that because there's a lot of resources on the internet today. What kind of standing, what kind of debt ratio do they have? What kind of inventory if they're selling products? What is their long-term view look like? There's several indicators and things that you do to make sure a company is good. And if that's your thing, you'll need to get a lot of education. You'll need to get a lot of tools. You'll need to get a lot of training in that. I'll give you the shortcut. You ready? I'm going to give you the secret. I'm going to give you the inside secret to investing. We like indexes. You'll hear me say that ad nauseum over and over. What is an index? An index is a group of companies. It's just a big basket of all kinds of different companies in all kinds of different market segments. Some of them will be in energy. Some of them may be in a different sector that's up and coming. There's just a variety that you're getting into. So in that, you're going to get winners and losers, but it's going to spread your risk out a lot better. Stock picking can be fun, but that's not to be confused with building your retirement. And many times it sounds sexy, if you will, to be a stock picker and I'm going to be a market guy, but that's not how you build wealth for the long term. As you begin, as you start, and I'm talking about you're getting started, you want to put in set intervals. Again, I'll get into this just a couple of questions down and how we do that. But you want to continually invest, and you want to invest in a good investment that has the risk spread across it. One stock may be able to go up, but it may be able to go down, and you can't afford that risk when you're building your retirement. So when we talk about what's a good stock, we're talking about a good company. And since we don't know all of the insides of that, if we're not in that daily, the easy way is you buy into all or a whole bunch of different companies that spread your risk.
So many companies are known for their management, people at the top of the management. Of course, one of the risks is that person doesn't stay. And companies like Disney have always been known for the quality of their investments. The vision holders, which was cast through them or through Disney himself. But you have to watch those closely if you're going to invest in that kind of a stock. You can't invest and then forget it. You got to be sure you anticipate. People in the market always buy on what they think it will be. And just because something is a hot item, like electric cars or batteries to go in electric cars, which two companies came out last month that went public that provide the batteries, but they're a year to 2 years away before they will be able to produce them in enough volume to go in it. So that would be, as you would expect, the stock came out, then it went back down. So that takes a lot of talent, gifting, and risk taking.
And again, that's not to discourage you from picking up a good stock here and there. That's okay. But what I'm trying to distinguish is, especially as we're talking to people many times who are just getting started in investing, the first thing you want to do is set a monthly increment that you can invest in your retirement in something that is safe and has good risk in it that doesn't overexpose you. So an index is a great, it's what we call broad-based across the market. And it's got a very low fee. That's why we like them. And many times the argument is, well, I can outperform that by doing certain things. Did you know that according to all of the data that we have, there is no empirical evidence that over the long haul, somebody can outperform the market. The best of the best have tried. Now, they may do it for 10 years, they may do it for 15, but there are very, very precious few managers who can outperform the market. That's because there's enough efficiency built into the market. So the easy way is to just buy into the broad market and continually do that, and you will have a beautiful retirement when it's time. It's an easy way to get there. So that's a great question. Unless you want to do quantitative analysis, which is beyond the scope of our broadcast, what we're doing here, buy into an index and just spread that across. Or if you can't get to that, a mutual fund, something that's more broad-based.
Yeah, I think what the index and the mutual funds offer is diversity, as you said. Yeah. Some industries, while they're up, others are down. And we know recently, because of the virus and all of that, retail stocks are down. And they used to be the place to invest in a Walmart or some places like that. High-tech stocks were so popular. Now they're down a little bit. So you have to be diversified, and that gives you that through the index funds.
Especially when you're talking about your retirement, because that's a different game than if I'm going to play the market a little bit. I've got a little bit of extra cash. I'm going to buy this stock. If it does well, that's great. If it doesn't, I haven't spent my rent money or my retirement money. So think broad-based when you do that. That's a very good question, though. I hope that you will continue to send in your questions. They mean a lot to us because we can talk about a lot of things, but what we really want to do is find out what's important to you, the level of understanding, the questions that you have. So hopefully that we can add value to your investment knowledge and that you can increase and grow in that and stay curious and read as much as you can, get as much information. But when you have a question, please feel free to just send that in to us. Send those questions in because we really do enjoy them, and answering them helps us to make sure that we're being relevant and pertinent to you.